So let's discuss number 4 on the FTSE list, another company I don't really like, but that is Unilever. It's another business that I would leave to pension funds. I'll quickly touch on why I don't like it. So if you just search Sven Carlin Unilever, you have Unilever stock analysis, and you also have Unilever intrinsic value, Nestlé and Kroger are better. But here on the Unilever stock analysis that I wrote in 2019, I discussed how the CEO of Unilever is delusional, how he did better than Warren Buffett, and I was very correct on that. For the last 5 years since that, Unilever didn't do anything. Of course, the valuation looks okay, but I think it's also skewed a little bit, so nothing spectacular there. Their priority now is growth because, as we discussed in the CEO is a marketing salesperson. That is what is possible to sell to pension funds. They are doing, and there are pension fund managers that have no skin in the game because they will lose your money, not theirs. They feel well about it, and who cares? But that's something that you don't want to have in your portfolio. So they sold 5 billion of revenue to get 11 billion of proceeds and spent 17 billion to get less revenue because these are growing and growing, and growth is what they will sell to the market. Try to pay a lot of money to buy things, get less money to sell things. Paula's Choice, all very competitive businesses. Then again, restructuring. When you read about restructuring, you know that it's not about restructuring. It's about the competitives of, I don't know, the soap you're using, whatever. Yes, these are great brands, but the new generations aren't as connected to those great brands. And that's why also the revenues have been stagnating, flat net income, flat margins. Something might change, but good luck for investing if it doesn't. Also, current net income is skewed by 2.2 billion gains on asset sales, so the P ratio is above 20. That is going up because of their acquisitions, even if they have sold assets. And these people are likely good people, but there is nothing spectacular with them to make a change in such an old company like Unilever. And if we take Unilever to our risk and reward quadrant, I think that the reward is a little bit lower than the market because of the skewed P ratio, unlikely growth, bad looking future due to high competition, and thus also the reward is below market and better by the S&P 500 for sure, and the risk is a little bit higher. So they don't have a good business like they have. For the same or even worse valuation, I have to put it on the low reward, higher risk side with Shell here. Thanks for watching. Check my research platform, my investments, my covered stocks portfolios. I'll see you in the next video.